Hello and welcome back to Report of Silver, your trusted place for daily gold and silver analysis, market breakdowns, and the latest updates that matter most to precious metals investors. If you believe silver is one of the most misunderstood and undervalued assets in the world today, then you are in the right place. On this channel, we go beyond the headlines. We look at what is really happening behind the scenes so you can make smarter decisions with your wealth. Before we begin, make sure you subscribe and turn on notifications so you never miss an important silver update. Today we need to talk about something very important. Silver just made a powerful move, almost 7% in a single trading session, and most people still do not understand why. Many retail investors are looking at the price chart and saying, silver is up. But serious investors know that price alone does not tell the whole story.
The real question is this: what caused this sudden surge, and what could happen next? The answer begins with geopolitics. This week, a major global event shocked the markets. A ceasefire agreement, one that investors believed would reduce global tensions, collapsed publicly. It did not happen quietly. It happened in front of cameras, live from the Oval Office. Markets had already priced instability. They believed tensions in the Middle East were cooling down. But suddenly, that confidence disappeared, and when confidence disappears, markets react fast. Silver did not wait. It moved immediately. Why? Because professional traders understand something many people forget. Markets do not only react to what is happening today, they react to what might happen tomorrow. When uncertainty rises, investors rush toward assets they believe can protect wealth. Gold usually gets the first attention, but silver often becomes the bigger mover because of its dual role. It is both a monetary metal and an industrial metal. That combination makes silver unique. Now let's talk about oil, because oil is directly connected to this story. The Strait of Hormuz remains one of the most important energy routes in the world. Roughly 20% of global oil passes through that narrow waterway. Any disruption there immediately affects global energy prices. Right now, that risk is very real. Shipping activity has already been impacted. Drone strikes, regional military threats, and growing uncertainty have increased fears of supply disruptions. When oil rises sharply, inflation usually follows. That matters because inflation changes everything. If inflation moves higher, central banks, especially the Federal Reserve, cannot easily cut interest rates. Investors had been expecting lower rates in the near future, but if inflation remains stubborn, those expectations may disappear. That is exactly why this week's CPI report is so important. The latest inflation data is expected to show a year-over-year number near 3.7%. That may not sound extreme, but it would represent the highest inflation reading in many months. More importantly, it would confirm something markets do not want to hear. Inflation is not gone. That changes the entire investment environment. Now think about what silver does in this kind of environment. When inflation stays high, when geopolitical tensions rise, when supply chains tighten, and when investors lose confidence in traditional markets, silver benefits. That is exactly what we are seeing. This week's 6.93% move was not random. It was not retail hype. It was not social media excitement. It was institutional money responding to risk. And that is a huge difference. Institutions move first. Retail usually follows later. That is why this moment matters. Silver is beginning to act differently. It is no longer moving like a normal industrial commodity. It is moving more like a monetary safe haven. That tells us that the market is starting to recognize silver's true strategic value. And this is only the beginning, because while everyone is watching short-term price moves, something much larger is developing underneath the surface: a global supply problem. Welcome back to Report of Silver. In Part 1, we talked about the sudden 6.93% jump in silver and why geopolitical tension helped trigger that move. But now we need to go deeper, because the real story is not just about politics or inflation. The real story is supply. And the silver supply situation is becoming more serious every single year. Let's start with one number that should immediately get your attention. 215 million ounces. That is the latest projected silver deficit according to the Silver Institute World Silver Survey. What does that mean? It means the world is expected to use 215 million more ounces of silver than it produces this year. That is not a small shortage. That is the largest annual silver deficit ever recorded. Read that again. The largest on record. And what makes this even more important is that this is not a one-time problem. This is now the 6th consecutive year of silver shortages. For 6 straight years, global demand has been higher than global production. That means something very simple. The world has been forced to use stored silver reserves to fill the gap, and those reserves are shrinking fast. Since 2021, above-ground silver inventories have fallen by approximately 762 million ounces. That is an enormous drawdown. Imagine a giant water tank that has been draining for 6 years, while more water keeps being taken out than added back in. Eventually, the tank gets too low. That is exactly what is happening in silver. Now let's look at where demand is coming from. Many people assume silver demand is mostly industrial, and yes, industry uses a lot of silver. Solar panels, electric vehicles, medical equipment, electronics artificial intelligence infrastructure, military systems. Silver is everywhere. But here's what is surprising. Industrial demand has actually softened slightly in some sectors, especially solar manufacturing, where companies are trying to reduce silver usage. That sounds bearish at first, but here's the twist. Investment demand is exploding. Physical bar and coin demand is expected to rise to around 227 million ounces this year. That is a 3-year high. Why are investors suddenly buying more physical silver? Because they see what is happening. They see shrinking supply. They see rising global risk. They see governments printing money. And they understand that silver is becoming harder to find. That changes behavior. People stop waiting. They start buying. Now let's talk about the COMEX, because this is where things get even more interesting. COMEX is the futures exchange where global silver pricing is heavily influenced. Most of the contracts traded there are paper contracts, not physical metal. That means people trade silver exposure, not actual silver bars. Normally that works. Most traders settle in cash. But recently, more traders have started demanding physical delivery. That creates pressure. Right now, registered COMEX silver inventory covers only about 13.4% of open interest. What does that mean in simple English? For every ounce of silver physically available, multiple paper claims exist. That is a problem if too many people want the real metal at the same time. Earlier this year, tens of millions of ounces were withdrawn from COMEX warehouses in just days. That is not normal behavior. That is a signal. Smart money is moving metal, and it does not stop there. Let's go to London, the other major silver storage center. The London Bullion Market Association vault system has reportedly lost around 40% of its silver holdings since 2021. That is massive. London is one of the world's biggest precious metals hubs. When its inventory drops that much, people notice. And the market has noticed. How do we know? Because silver lease rates spiked dramatically. Normally, borrowing physical silver is cheap, very cheap. But during periods of stress, lease rates jumped as high as 40%. That is extraordinary. That tells us physical silver became difficult to source, not expensive. Difficult, that is a very important difference. When physical metal becomes hard to locate, markets begin to reprice risk, and prices can move fast. This is why silver is becoming so exciting right now. Not because of hype, because of fundamentals, because the math is simple. Less supply, more demand, shrinking inventories. That equation usually ends one way: higher prices. Report of Silver, Part 4. The bearish case, what could slow silver down? Welcome back to Report of Silver. So far, we have talked about the bullish case for silver, geopolitical risk, rising institutional demand, and a major physical supply deficit. All of those factors are very important, and they help explain why silver has been performing so strongly. But good analysis is not just about seeing the upside. A true analyst must also examine the risks. What could stop silver from moving higher? What could create short-term weakness? And what should investors watch carefully before making decisions? That is exactly what we are going to cover in this part. First, let's start with the most obvious risk: volatility. Silver has always been one of the most volatile precious metals. It can rise very quickly, but it can also fall very quickly. We just saw silver jump nearly 7% in one session, which is exciting. But history shows us that silver often gives back gains just as fast. That is why emotional investing can be dangerous. Many new investors buy after a big rally, only to panic when prices pull back. That is normal market behavior. Volatility does not mean the long-term story is broken, but it does mean investors need patience. The second risk is the Federal Reserve. Federal Reserve policy still matters greatly to precious metals. If interest rates stay higher for longer, that can create pressure on silver. Why? Because higher rates strengthen the US dollar and make non-yielding assets like silver less attractive to some investors. Right now, markets are debating whether rate cuts will happen this year or much later. If inflation remains high, the Fed may delay cuts even further. That could create short-term headwinds for silver prices. Third, we need to talk about industrial demand risk, especially solar demand. This is one of the most common bearish arguments today. Solar manufacturers are working hard to reduce silver usage in photovoltaic cells. Some companies are experimenting with copper-based alternatives. If successful, that could reduce one major source of silver demand over time. And yes, that is a real risk, but it is important to keep perspective. Even if solar demand drops modestly, the current silver deficit remains enormous. A small reduction in industrial demand does not erase a 215 million ounce shortage. Still, investors should monitor this trend closely. Another risk is economic slowdown. Silver is unique because it behaves both like a precious metal and an industrial metal. That is usually a strength, but during recessions it can become a weakness. If the global economy slows sharply, industrial demand for silver could weaken. Less manufacturing means less silver use in electronics, vehicles, and technology. That could temporarily pressure prices, even if long-term fundamentals remain strong. Now let's discuss one more important issue: profit taking. When silver rises quickly, some investors sell to lock in gains. This is normal. It does not mean the trend is over. It simply means markets need to breathe. Strong rallies often include corrections. In fact, healthy pullbacks are often necessary because they remove weak hands from the market and create a stronger foundation for future gains. So if silver drops 5% or 10% after a major rally, that should not automatically cause fear. It may simply be part of the process. There is also the psychological barrier of historical highs. Silver still remains below its all-time peak. That matters because some investors remember previous rallies that failed. They may hesitate to buy aggressively until silver breaks those old levels convincingly. Markets often struggle at major resistance points because old memories influence investor behavior. And finally, there is always the possibility that markets have already priced in some of the bullish news. If traders have already anticipated shortages, inflation, and geopolitical risk, silver may consolidate before making another major move. Markets do not move in straight lines, they move in cycles. So what does all this mean? It means silver has strong long-term fundamentals, but that does not guarantee a straight path upward. There will be volatility, there will be setbacks, there will be days when headlines look bearish. That is normal. The key is understanding the difference between short-term noise and long-term direction. Now let's move into the most important part of this entire silver story, and that is the physical supply crisis. This is where the conversation changes from theory to reality. For years, many investors believed silver shortages were just rumors or exaggerations. They thought there was always enough silver available because the price stayed relatively low. But now the numbers are proving something very different. The Silver Institute has officially released its latest global silver report, and the message is clear. The world is using far more silver than it is producing. According to the latest data, the global silver market is facing a deficit of 215 million ounces. That means demand exceeds supply by 215 million ounces in just 1 year. And this is not a one-time problem. This is now the 6th straight year of deficits. Since 2021, the world has been consuming more silver than miners and refiners can replace. That creates a major long-term imbalance. Now think about what that means. If the world keeps using more silver than it produces, where does the extra metal come from? It comes from existing inventories. It comes from above-ground stockpiles. Silver sitting in vaults, warehouses, and reserves. But those inventories are shrinking rapidly. Since 2021, over 762 million ounces of above-ground silver has been drawn down to fill this gap. That is an enormous amount of metal. It means the cushion that protected the market for years is disappearing. Eventually, that cushion becomes too small. When that happens, price has only one direction to go: up. Now let's talk about COMEX, because this is where many people believe silver price discovery happens. COMEX is the futures exchange where silver contracts are traded. Most traders never take physical delivery. They settle in cash. That has allowed the paper market to dominate price for decades. But now something unusual is happening. More traders are demanding physical delivery. They do not want paper promises anymore. They want real metal. That creates stress in the system. Right now, COMEX registered silver inventories cover only about 13.4% of total open contracts. Think about that. For every 1 ounce of registered silver available, there are multiple claims against it. That ratio creates risk, and it gets even more interesting. In recent delivery months, we have seen major withdrawals from COMEX warehouses. In one 7-day period earlier this year, over 33 million ounces left the vault system. That is not normal. That is physical metal walking out the door. When that happens repeatedly, it tells you institutions are becoming nervous about supply. They are choosing possession over paper. That is a major signal. Now let's shift to London, because the London Bullion Market Association, or LBMA, is another key global silver hub. Since 2021, LBMA silver holdings have dropped by roughly 40%. That is huge. 40% of their physical silver inventory is gone. This is not because people are panicking. It is because demand is quietly draining the system. At one point last year, available silver in London dropped so low that lease rates exploded. Normally, borrowing silver costs less than 1%. But during peak stress, lease rates surged toward 40%. That is extraordinary. Markets only do that when supply becomes extremely tight. Even retail markets are feeling this pressure. Bullion dealers in several countries have reported shortages of popular silver coins. Premiums rise when that happens. Delivery delays increase. Waiting lists appear. These are early warning signs. Most investors ignore them, but they matter. Now here is what makes this even more powerful. Industrial demand remains strong. Yes, some solar manufacturers are reducing silver usage, but that does not solve the problem. Silver demand is not just solar, it is electric vehicles, medical devices, semiconductors, artificial intelligence infrastructure, batteries, defense systems, and advanced electronics. Silver touches almost every modern technology sector. At the same time, investment demand is rising sharply. That means both industry and investors are fighting for the same limited supply. This is why silver is no longer just a commodity story. It is becoming a strategic asset story. Governments know it. Institutions know it. Central banks are starting to understand it. And slowly, investors are beginning to realize it too. Once the market fully accepts that silver is physically scarce, price may need to reprice dramatically higher to restore balance. That is the real silver story, and most people still have not seen it yet. Part 5. Paragraph format. Part 5. What happens next for silver, and why this could be the defining opportunity. Now we arrive at the final and most important question. Where does silver go from here? After everything we have discussed, the geopolitical tensions, the inflation risks, the Federal Reserve changes, the supply shortages, and the institutional money flows, it becomes clear that silver is entering a completely different phase. This is no longer just another commodity cycle. This is a structural shift. And when markets go through structural shifts, prices can move much faster and much higher than most people expect. Let's start with price. Silver recently surged nearly 7% in a single trading session. That is not normal for a metal market. That kind of move tells you something important. Money is entering fast. Institutional traders are repositioning. Large investors are not waiting for headlines to confirm the trend. They are acting before the public catches on. That is usually how major bull markets begin. Quietly at first, then suddenly everyone notices. Right now, silver is still trading below its all-time high. That means even after this strong move, silver has not yet entered true price discovery mode. Historically, once silver breaks major resistance levels, momentum can accelerate rapidly. We have seen this before. In past bull markets, silver did not rise slowly. It exploded upward in waves. A move from current levels toward $100 is no longer unrealistic. Some major institutions are already publishing much higher targets. Bank of America, for example, has placed an upper target near $309 per ounce. Whether silver reaches that level or not is not the point. The point is that serious institutions now see the potential for a much larger move than most retail investors imagine. But price is only one side of the story. The bigger story is confidence. Confidence in paper markets is weakening. Confidence in central banks is weakening. Confidence in fiat currencies is weakening. And when confidence falls, investors search for hard assets. Gold has always benefited from this. But silver adds another layer. It is both monetary and industrial. That makes it unique. It is a store of value and a strategic industrial resource at the same time. This is why governments are changing their language. The United States officially added silver to its critical minerals list. That is not symbolic. That is a recognition of strategic importance. Russia has moved silver into sovereign reserve discussions. China is aggressively importing silver while restricting key inputs needed to produce more of it. These are not random events. These are strategic decisions. Nations do not behave this way unless they understand the metal matters. Now, does this mean silver only goes up? No. Markets never move in straight lines. Silver is volatile. It will correct. It will pull back. It will frustrate investors. Some days it may drop hard, just like we recently saw. But that volatility is normal. In fact, volatility is part of silver's personality. Long-term investors understand this. They do not panic during pullbacks because they focus on the bigger picture. And what is the bigger picture? The bigger picture is simple. Demand is rising, supply is tightening, and above-ground inventories are shrinking. That is a textbook bullish setup. Add in geopolitical instability, inflation uncertainty, and institutional accumulation, and you have the ingredients for a major long-term move. This is why silver is attracting attention again, not because of hype, not because of social media excitement, but because the data is becoming impossible to ignore. The market is speaking through prices, through shortages, through delivery requests, and through capital flows. So what should investors do? First, stay informed. Do not follow noise. Follow facts. Watch supply data. Watch central bank policy. Watch institutional positioning. Second, understand your own strategy. Silver is not for emotional investors. It rewards patience. Third, recognize timing matters, but perfect timing rarely exists. Most wealth in markets is built by those who position themselves before the crowd arrives. That is the key message today. Silver is not just reacting to headlines. It is responding to a deeper global shift. And if that shift continues, the next chapter for silver could be much bigger than most people are prepared for. This is why we watch. This is why we analyze. And this is why silver still matters, perhaps now more than ever.